I want to talk about something that is kind of the buzzword in the industry right now, rate buy downs. Now, as a listing agent, I know I use it as a really great marketing tool, but explain what a rate buy down is and the perks to the buyer.
Okay. So, traditional, you'll hear about people paying points for a permanent buy down. So you may pay right now 1 point or 1% of your loan amount to lower that interest rate permanently, say a quarter, 3/8 of a percent. Okay. With a potential refinance market coming, with rates dropping, you may not want to pay a permanent buy down because you won't save enough in that monthly payment to recoup what you spent before refinancing. Okay. So the other buzzword, the other big buy down thing right now that's popular is a temporary buy down. Okay. We're seeing a lot of 2-1 buy downs. So once again, back to marketing, those lower rates. With that, the seller will contribute the allotted amount of money needed to buy down your rate 2% for the first year. Okay. So simple numbers, if today's 7%, your first year's interest rate is at 5%. Okay. So your payment's based off a 5% interest rate. The second year, 1% lower, so your payment's based off of 6%. Okay, so that's a 2-1 buy down, 2%, then 1%, then to the rate that you locked in, which in this scenario would be 7%. So what that is the seller paying to supplement your payment over those years.
And they pay it up front at closing.
Pay it at closing.
Essentially, you're telling me that it is better for a buyer to maybe pay for a house and pay $615,000 purchase price with like a $15,000 credit for a 2-1 buy down than it is for them to take it off the purchase price and buying the house at $600,000.
Sure, because if you're lowering the price $15,000, every $1,000 is going to change your payment about $6 a month. Right. So 15 times 6, you're talking $75, right? The 2-1 buy down in those first couple of years, if it costs the seller $15,000, you are saving $15,000 in payments in those first 2 years.
Which is a great savings.
Yeah, so it's putting that money in your pocket, which is definitely more than the $15,000 off your purchase price.
Yeah, I know that as a listing agent, this is something I'm always looking into because you almost want to offer it. Like I said, it is a marketing tool, but a lot of buyers are very excited about this opportunity because rates and because it has been so, unaffordable to buy right now.
Yeah. It's nice because it's also just a stair step.
Yeah.
When you're going from renting, you're probably going to spend more per month when you buy. You know that's coming, right? Right. But this lets you ease into it. And then ideally in this market, you refinance before that third year when the highest rate comes into play. And then you end up with a payment in the range that you started with, somewhere in the middle. Yeah.
And hopefully we will see a trickle down effect in 2024. That's everyone's hope right now. Please. I do want to talk about, so when you purchase a home and you're a home buyer, everyone was always kind of focused on down payment. And while down payment is important, there are other factors to purchasing. Tell us what is all due at closing that a buyer needs to take into consideration.
At closing, so you're going to definitely come with your down payment, right? That's the money that you've determined with your lender, 3%, 5%, 10%, whatever, plus closing cost. There's going to be some standard closing costs. You've got lender fees, you've got an appraisal, some third-party items that you have to basically get done to get to closing. Yeah. Title fees, and then there's prepaid items. So prepaids is exactly as it explains, prepaid. You're going to prepay a little bit of your taxes and insurance to put into an escrow account to pay your escrow pays your taxes and insurance as needed. If you don't have an escrow account, you'll pay it on your own, but you'd have to put at least 20% down to
void the escrow account, right?
Yeah.
If I'm closing in April versus end of November, is there a big difference in my prepaids and my closing cost?
It's going to look like it's a bigger difference because we're going to collect more to put into that escrow account to pay the taxes at the end of the year. But you're going to get a credit from the seller for the portion that they're covering. Right. So it's all prorated. It's going to look like more, but on average, as a buyer, you're going to contribute about 2 to 3 months of taxes and insurance. So that's your out-of-pocket expense. It might look like we're collecting 10, but the seller's paying for 7. Right. So there's your 3.
Okay. Okay, I want to go back to the 2-1 buy down or the 3-2-1 buy down. So with predictions of rates coming down, so let's say I do a 2-1 buy down and then rates, in 6 months or a year drop pretty low. Does it make sense to go ahead and refinance or to keep the 2-1 and kind of wait out the market?
I would, of course, trust your loan officer. We're going to help determine when is a good time to refinance.
Okay.
There's plenty of lenders out there that will refinance you when it doesn't make sense. So make sure you're using somebody that you trust. But back to the 2-1 buy down and that example that we used earlier, if the seller paid $15,000 to supplement those first 2 years of payments and you refinance at month 18, so less than 24 months is the first 2 years, you've got 6 months of that supplemental money that the seller gave, and it's not going to disappear.
Okay.
When you refinance, that portion is applied towards your principal, lowering the balance. So if you had purchased at a X price or price reduction, this still is applying towards your principal. Whereas that permanent buy down, if you refinance, if the recoup time is 36 months and you refinance at month 18, then you've lost that money you spent. You don't get any sort of refund.
So really overall for a buyer, they should take advantage of buy downs.
Yeah, I think it's a great opportunity. It's helping buyers feel more comfortable in this rate market.
Yes.
We have seen rates lower recently, which is great news, but still, even if the rate comes down, you can still try to negotiate with the seller a 2-1 buy down. There's a 1-year buy down. You mentioned a 3-2-1 buy down. Those get a little bit more expensive for the seller, so it's how you
depends on the seller's pain point and how much we would negotiate.
Yeah.
Okay. And I know that I always try to figure out all those numbers on the front end before proposing it, because we do need an exact number on the contract, correct?
Right.
Yes.
The cost of the seller is dependent on your loan amount and the interest rate. Because it's the interest that they're paying.
Right.
So it can adjust slightly.
So typically you do need to get the buyer pre-approved because it's going to be determined on their credit score, yes?